How do banks lend money? This section will provide you with hands-on knowledge of how retail banks lend money to individual customers and small and mid-sized enterprises. Starting from the basics of lending, which includes meticulous techniques useful in making challenging credit decisions. In the end, we will also examine practical case studies of a few customers that are seeking loan approvals. Banks typically generate money by borrowing funds from depositors and rewarding them with a reasonable interest rate. Banks then lend the money to borrowers, charging higher interest rates and benefiting from the interest rate spread. Banks also keep a fraction of deposits as reserves, which is called fractional reserve banking. To see how this lending process creates a money supply, here is an example. Assume that the reserve ratio set by the central bank is 10%. The reserve ratio is the percentage of a retail bank's deposits that it must carry in cash as a reserve in the event of large customer withdrawals. This means for every dollar deposited, the bank must hold 10%, which is $0.10 in reserve, and the rest $0.90 can be lent out. Required reserves is equal to reserve ratio into bank deposits. Making credit decisions. Making credit judgments may appear to be a straightforward task these days. With the development of the credit scoring system for mortgages and personal loans, automating the personal judgment process in which a computer determines whether or not the money should be loaned. But this is not the reality. JP Morgan estimates that its investors lost $22.5 billion on $87 billion of bonds issued on low quality mortgages sold in 2006 and 2007. What they did wrong was made lending decisions at the bank level based on do they fit the criteria specified rather than can they afford it, or are they suitable people to take on long term commitments. Furthermore, guarantees were provided by underwriting agencies so that banks would not be responsible for any losses on mortgages passed through the agencies. There are numerous lending institutions available today, ranging from non-profit cooperatives to payday lenders, each with a unique target market, strategy, and interest rate regime. Therefore, retail banks must be clear about their objectives and have an appropriate strategy in place to function properly. Retail banks work to provide their core products to mainly individual customers, seeking a satisfactory, not very high interest rate and targeted at a very low default rate. Some factors that retail bankers should be aware of to create a successful lending process are: first, risk and reward. Retail bankers need to be aware of the fact that unlike other lending institutions, the bank should be seeking a banking return rather than an investment return. Therefore, they need to be conservative here. If not, they could easily lose money because if the lending is successful, they get their money back with interest. But bank does not share the profits earned on the money by the borrower. So, they should not be taking excessive risks. This should be left to investment or equity financiers. Second, ideal borrower. There is no ideal borrower. In retail lending, if customers ticked every box of the list credit wise, they wouldn't need to borrow from the bank. Third, information source. Today, much information about customers and SMEs is available on the internet, social media, credit databases, and various company listings, but for a retail banker, most relevant and vital information can be gathered by questioning the borrower.